Geopolitical tension is at its peak. Iran and the United States trading threats, airstrikes, sanctions, military movements, and somewhere in the background, your investment account quietly turning red. If you're an investor, even a small one, even if you just have a 401k you check once a week, there's a very human question sitting in your chest right now. Is my money safe? Because war isn't just something you watch on the news. It seeps into oil prices, it shakes currencies, it rattles stock markets, it shows up in your retirement account before you even finish your morning coffee. Today on Wealth Talk, I want to walk through this calmly. No drama, no panic, just clarity. What does an Iran-US conflict actually mean for your wealth? Who gets hurt? Who benefits? And what are the 3 mistakes people almost always make in moments like this? Take a breath with me, because markets hate one thing more than war. They hate uncertainty. And right now, uncertainty is everywhere. Here's something most people don't realize. Historically, markets don't collapse simply because a war starts. They collapse when investors don't know what's coming next, when leadership is unstable, when retaliation is unclear, when oil supply might get disrupted but no one knows by how much, when headlines shift every 6 hours. That's what we're seeing with tensions between Iran and the United States. It's not just about military action, it's about potential escalation. It's about oil routes in the Strait of Hormuz. It's about sanctions. It's about global alliances. And markets price in fear instantly. The S&P 500 doesn't wait for confirmation. Oil futures don't wait for clarity. Traders react to probability. You might wake up and see your portfolio down 2%, 3%, maybe more, and suddenly it feels personal, like something is being taken from you. But zoom out for a second. Think about past conflicts, the Gulf War, even the early days of the Russia-Ukraine war. Markets dropped sharply in the short term, and then, once the scale became clearer, they stabilized. Not because war is good, but because clarity is stabilizing. And that's the psychological trap. When things feel chaotic, our brain wants to act, to do something, sell, move to cash, protect. But sometimes the most rational move feels emotionally uncomfortable. Let's talk about sectors, not in a technical way, just in a practical, human way. Imagine oil prices jump because there's concern about Middle Eastern supply. Who feels that first? Airlines. Companies like Delta or American Airlines operate on thin margins. Fuel is one of their biggest expenses. When oil spikes, their costs spike, and investors know that. So aviation stocks often fall during geopolitical tension. Now think about logistics. Shipping companies, freight operators. Higher fuel costs squeeze them too. Then you have high-growth tech companies. Why would they fall? Because geopolitical tension often pushes inflation higher. Higher oil means higher transportation costs. Higher transportation costs ripple through everything: food, goods, services. And when inflation rises, central banks hesitate to cut interest rates. Growth stocks, the ones priced based on future earnings, don't love high interest rate environments, so they often pull back. Not because they're bad businesses, but because money becomes more expensive. So if you're heavily invested in tech and you see red days during geopolitical tension, it's not random, it's math mixed with emotion. Now here's the other side of the story. Conflict creates fear. Fear creates demand for security. Defense companies often see investor interest rise. In the U.S., companies like Lockheed Martin or RTX Corporation, formerly Raytheon, tend to attract attention during military escalation. Why? Because governments increase defense spending when threats increase. Then there's energy. If crude oil rises, oil producers benefit. Higher prices mean higher revenue per barrel. Energy stocks often move in the opposite direction of airlines during these moments. And then we have what people call safe havens. Gold, the US dollar. When global tension rises, investors look for assets perceived as stable. Gold has played that psychological role for centuries. The US dollar tends to strengthen because it's considered a reserve currency. It's fascinating, isn't it? In the same week your tech ETF might be down, a gold ETF could be quietly climbing. That's not manipulation, that's capital flowing toward perceived safety. Now let's get personal, because this isn't about sectors, it's about you. The first mistake people make during geopolitical tension is panic selling. You open your brokerage app, you see red, your stomach tightens, and you think, I'll sell now and buy back later when things calm down. It sounds logical, until you realize that later almost never feels safe enough. Markets often rebound before headlines feel positive again. If you sell after a drop and wait for good news, you risk buying back higher. I've seen people sell during temporary dips only to re-enter months later at higher prices, not because they're unintelligent, but because fear is persuasive. The second mistake is overexposure. Some investors run 100% equity portfolios during calm times. That works beautifully until volatility spikes. When your entire net worth swings wildly in a week, it doesn't just affect your portfolio, it affects your sleep, your mood, your decisions at work. If your rent is due, if groceries are more expensive, if your kid's tuition payment is coming up, volatility feels heavier. Diversification isn't about maximizing returns, it's about protecting your psychology. The third mistake is freezing, not adjusting at all, not reviewing allocations, not checking risk exposure, just hoping it passes. Sometimes hope works, but sometimes small adjustments, like trimming a little exposure, building a bit of cash, adding a stabilizer like bonds or gold, can reduce emotional strain significantly.
Let's make this practical. I'm not talking about drastic moves, not selling everything and hiding in cash. I'm talking about balance. If someone had 100% of their investments in equities, it might make sense, psychologically, to shift a portion into cash or more defensive assets, not because the market is doomed, but because flexibility reduces fear. Think of it like this. If you have some cash available, a war chest, sudden dips feel less threatening. They feel like potential opportunity. When markets drop due to fear, strong companies often get discounted along with weak ones. Having cash means you can act thoughtfully instead of react emotionally. And here's something people underestimate. Just knowing you have optionality reduces anxiety. It's the difference between feeling trapped and feeling prepared.
Let's say you're a 32-year-old professional. You've been investing consistently. You check your 401k during lunch breaks, even though you know you probably shouldn't. News of escalation hits. Oil spikes. Markets dip 4% in a week. Your first instinct is worry. But instead of reacting, you zoom out. You remind yourself that you're investing for 20, 30 years. You review your allocation. Maybe you realize you're comfortable with the volatility, so you stay the course. Or maybe you notice you're more stressed than you thought, so you gradually move 10% into something more stable. Not dramatic, not extreme, just aligned with your risk tolerance. Or maybe you build up your emergency fund a bit more aggressively over the next few months, because global tension reminds you that stability isn't guaranteed. That's not fear-based, that's mature. And if markets drop further, instead of doom scrolling, you consider whether high-quality companies you already believe in are temporarily discounted. Not because someone on social media told you to buy the dip, but because your long-term thesis hasn't changed. That's the difference between reacting and responding.
Here's something grounding. The global economy has survived world wars, oil shocks, financial crises, pandemics, political chaos. And yet, over decades, markets have trended upward. Not in a straight line, but upward.
That doesn't mean there won't be pain. There will be volatility. There will be uncomfortable months. But wealth building has always required enduring uncertainty. If your financial plan only works in calm weather, it's not a plan, it's optimism. The goal isn't to predict geopolitical outcomes. You and I don't control that. The goal is to build a financial structure that can absorb shocks. Because shocks will come. They always do.
If you're feeling anxious right now, that's human. You work hard for your money. You sacrifice time. You delay gratification. Of course, you don't want to see it fluctuate because of something happening thousands of miles away. But remember this, volatility is not the same as permanent loss. Headlines are loud, markets are emotional, but disciplined investing is quiet. Sometimes the most powerful move you can make is to sit still, with intention. Other times, it's to make small, thoughtful adjustments. Not dramatic, not reactive, just steady. Conflict between nations is unsettling, but your personal financial journey is longer than this moment. Progress beats perfection. Calm beats panic. And clarity, especially in uncertain times, is one of the most underrated financial advantages you can have. Take a breath. Your wealth isn't built in a week, and it's rarely destroyed in one either. Stay steady.